Hi, welcome to this AQA A-Level Business Revision video, focusing on 3.5.1 setting financial objectives. We're going to be focusing in on gross profit, operating profit, and profit for the year. A reminder that my teaching here is not linked to my consultation or teaching roles in any and all academies throughout the country. My name is Mr. Giles. Let's get down to business. Before we begin, it's important that you've watched my 3.1.1 measurement of profit. I believe it's called Profit, Total Costs and Revenues. It's important that you've watched that video because there are many concepts in there that double up onto this that we won't be covering in this video. We've moved on to Unit 5, which is financial management, and specifically into gross operating and profit for the year, sometimes referred to as net profit. It's important to understand the distinction between these profits and the generic phrase of profit as we learned it in Unit 1, which was just revenue minus total costs. These specifically are found on financial statements such as the income statement, whereas the profit calculation, which is revenue minus total costs, is our generic formula for profit. You're going to need to know both. Fortunately, this moves on to other things such as financial ratios, and I will encourage you to move straight onto that video after this one, which is 3.5.2, analysing profitability. However, from Unit 1, the profit calculation of revenue minus total costs links very heavily to the break-even concept, which again, you'll find in a video in the playlist. So let's get down to business here. First of all, let's look at gross profit. Gross profit is the first profit we calculate on the income statement. It takes into consideration revenue, which again we've looked at in previous videos and I won't go over again, and we take away cost of sales. The easiest way to think about cost of sales is purely to consider our raw materials. Now, if you're producing products, that is physically the raw materials that you need to make those products. So if you're making pens, you need plastic and ink, for example. If you're selling products, then your raw materials are the purchasing of the products that you're putting onto the shelves. Where this becomes tricky is if you provide a service. So I often like to teach this via a hairdresser example, because if you're a hairdresser, your raw materials are probably things like shampoo and conditioner, maybe products that the clients get in their hair, etc. So you probably don't have a very large amount of raw materials. That's why this calculation and the following calculations become a little bit more useful to businesses. If you're a hairdresser, your gross profit should be really big because your cost of sales should be really low. However, if you're Tesco or you're Ford and you're manufacturing cars, you'll probably find that your gross profit is very low because your raw materials are very expensive. They take up a large proportion of all of your expenses. Now, why is that important? Well, if we measure year on year our gross profit and we see that our gross profit is improving, but our revenues generally stay the same, it means our cost of sales, our raw materials have gotten cheaper. And as we know, that's economies of scale. However, if our raw materials are getting more expensive, but our revenues stay the same, then we'll probably see a reduction in our gross profit. Essentially what we can do is we can look at our financial statements and look at our income statement and say, where are we losing money? Where are we seeing an increase in costs? Is it in the raw materials or is it in some other expenses? And if we can do that, then we can minimize costs. And remember, whenever we're talking about profit of any description, it is a key marker of performance for a business. So we're looking to increase revenues or decrease costs. Up next, we've got operating profits. Now, this is when you take your gross profit and you minus away all other expenses. So it's not as delicate as, say, variable costs and fixed costs, but it does not consider the raw materials. So over here in pink, I've written probably the 4 biggest expenses of most firms and businesses. So wages and or salaries, depending on how they're paid. And again, if you don't know the difference between wages and salaries, go back to the 3.1.1 video and have a look at that. I'll give a good explanation now. And then rent/mortgages. So if our operating profit is declining over time, but our revenues have stayed roughly the same, then our wages and salaries have probably gone up, or our rent and mortgages have gone down. Now, let me go back to a previous point I've just said. We divide up our expenses into gross profit and operating profit because it allows us to see where we're losing money, i.e. where we're spending money. And if we take into context the business we're talking about, so if I use my Tesco and my hairdressers examples, it's like using dials or sliders on a DJ desk, because the business can see, well, hang on, where are we losing money and what can we dial down? What slider can we bring down to try and reduce the costs, to try and improve these profitability measures? But if you're a hairdresser and you see that your raw materials are really expensive, that dial or slider is probably really easy to come down. You can buy, generic off-brand products to use in your salon. People probably won't know, okay? But if it's your wages and salaries that are causing you a lot of money because workers are threatening to leave, so you have to give them a pay rise, etc. As a hairdresser, you can't really bring those down. You could maybe let those people go or try and move them on to try and find cheaper hairdressers, but then you're compromising the quality of the haircuts that are being done. So that one's really tricky. So in that instance, if you're a hairdresser and you've brought your raw materials down, but you still see that your wages and salaries are your greatest expense, there isn't really a lot you can do about that without compromising the quality. You've got to find a way to improve the revenues instead. And vice versa. If you're, say, Tesco or Asda or Sainsbury's, and you see that your raw materials are quite high, there's nothing really you can do about that because you've got to have things on the shelves. You try and get some economies of scale with some of your suppliers. You try your best there. If it's your wage or your salary bill that's the next biggest expense, then maybe that's the time when you start removing people from the organization and doing capital intensive instead, where you start getting machines in like self-service. So that's why these two calculations are somewhat useful for a business, because they allow you to find out where you're losing money and make decisions from there. A little bit of secret sauce here. They often like to link gross profit and operating profit to concepts like just-in-time production. If we think about just-in-time production, it's when we get our raw materials just as we need them. So we basically forego any and all economies of scale. So we would expect an increase in our cost of sales. But if we're not storing loads of raw materials, we don't need a big factory. We don't need a big rent bill. So we would see a reduction in our expenses. So our gross profit might shrink a little bit because we're not getting those lovely economies of scale, but our operating profit should significantly increase. If you're in year 13, you'll also know that operating profit is a key measure for some of the financial ratios that you need to know. If you're in year 12 and you don't know what that is, don't panic. The operating profit, as we know, is very useful in ROCE, return on capital employed. So if we're not getting a very good return on capital employed, we can then start working backwards through our operating profit calculations and our gross profit calculations to find out why. Why is the ROCE not good? Is it because cost of sales are too expensive, or because all of our other expenses are too expensive? Just a little bit of secret sauce there for you. Lastly, we have profit for the year. Fortunately or unfortunately, depends how you want to look at it, over the last 7 years, 8 years, AQA haven't really put a lot of emphasis on this particular calculation. They've asked it a couple of times in multiple choice and various other places, but they haven't really zoomed in on why this is important to a business. So take from that what you will. The profit for the year is where we take our operating profit and we take away any tax that we owe and any interest on any borrowed money. And that's actually really important. We often look, when we think about borrowed money as a source of finance, we think about bank loans and mortgages, for example, and we often look at the short-term cash flow impact of that. So if I get a bank loan, I have to pay it back. How's that going to impact my day-to-day business? Because it's physical money leaving the business. However, if we don't consider the interest payments, then are we really truly looking at the cost of borrowing that money? And you'll notice down here in pink, I've put the word dividends. The dividends that are paid out to the shareholders, so anybody who receives a share of the profit of this business, is going to be impacted by that borrowed money. And this is actually a really nice chain of analysis when we're talking about borrowed money. Remember, AQA love asking you questions about whether or not you should borrow money or not, whether you should use share capital or not. A really nice chain or layer of analysis is to talk about how the interest on borrowed money has a direct impact on the dividends paid to shareholders, which is why shareholders don't want businesses borrowing money. They'd rather that they use the share capital that they've got instead. So that's just an interesting way of looking at it. This is the final profit for the business, but I think it's often overlooked because tax can vary year to year. Businesses are often allowed to pick how much tax they want to pay as and when, to a certain extent. Don't take that for gospel. And And then the interest payments, again, will vary depending on how much borrowing has occurred in that year. So it's much more variable and harder to pin down as a solid answer. We much prefer using operating profit as a true measure of success for the business. However, this link back to the dividends received is somewhat important. Just a reminder, this is often referred to as profit for the year. So there's your gross operating and profit for the year formulas and what they mean. I'm going to highly encourage you move over to 3.5.2, which is the look at the ratios part of this now, because that's where we can really tell the story. Thanks for watching. If you have any questions, put them in the comments below and I'll try to get to them. See you in the next one.